Lovely. Okay. Start recording. Lovely. Okay. So welcome everyone to our CBAM Q1 review and portfolio performance review and outlook. We've got Sam and Mark with us today to go over their presentation. Normal layout, obviously, if anyone has any questions or anything they want clarifying during the course of their presentation, then please just pop it over into the Q&A section to your right, and we will go over that at the end. We're looking at about 45 minutes today, but we have factored in some time for those questions. And we will also put a small survey up at the end. So those of you who have got 30 seconds of time just to leave that feedback, obviously we will really appreciate it on our side. Otherwise, I will let you guys carry on.
Thank you, Jess. Thank you everyone joining us live for the webinar, and hello to everyone that sort of watches it on repeat as well. Certainly nice to come into these quarterly sessions with with a more positive outlook. 2022 and some frustrations in 2023 sort of sometimes made the tone of these sort of more negative than we'd like, but we also feel it's our job to report and explain bad periods and down periods just as much as the positive ones. But it's been nice sort of again moving into a third quarter now with the portfolios currently up quarter to date, and obviously having the strong year-end rally we had end of quarter 2023, and a positive 2024, which leads into Sam going into a bit more detail in what have been the key trends and focuses.
Yes, hi, good morning everyone. Thank you for joining us on a Wednesday. Apologies for the change of date. Unfortunately, or fortunately, depending on viewpoint, I am attending investment conference tomorrow, so obviously important that I attend. So thank you for changing your schedule to join on a Wednesday instead. Just a couple of quick housekeeping bits just to illustrate that this presentation is for information purposes only, doesn't constitute any kind of advice or recommendations. Cape Berkshire Asset Management is an appointed representative of Ascot Wealth Management, which I'm sure you already know, and are regulated by the FCA. And also that these investments aren't suitable for everyone. You should be seeking financial advice before investing in a Cape Berkshire portfolio. And also that these investments may fall or rise more than other investments. But of course, that's by and large a standard part of investing. Just do my usual thing of jumbling around the slide order. Just quickly wanted to look at what our looking forward was actually, what we put in the last webinar as to what the possible macro factors could be for the last quarter. Just looking there, saying about inflation with core CPI being sticky and perhaps people being over optimistic for where inflation was trending, particularly in the US, and indeed that's proven the case, and that fed very much to point number two. In quarter four, we had that huge government bond rally, and the note off of that was, there was government bond over optimism, and we were expecting a pullback, and that has occurred, and we were positioned well to cover ourselves for that. And then China valuations being very cheap. China has been had a little bit of a wobbly patch, but it's come back nicely, and people are recognizing far more now the valuations that China propose, and that the Purchasing Manager Index data is also improving in quite a few areas, particularly in UK and Europe, which it's going to prove potentially very good heading into quarter two, and Q1 earnings season has been pretty good. So looking at what that meant for the quarter in terms of performance, you can see here a range of between 1.14% for the 1P1 portfolio, which is very much more high proportion in government debt. As mentioned, there was that over optimism, and we've had yields increasing somewhat. Actually, yesterday the US 10-year Treasury started trading within the range it was at around October last year, which just demonstrates that actually we've kind of come back to where we were 6 months ago, all the way through to CBAM R5, which has returned 7.31% on the quarter. So very positive there. We've had quite a lot of an equity rally, and that we've also positioned ourselves well to capture that ahead of benchmarks, which is very positive indeed. Just to recap of what that's meant for the 1 year, we can see performance of up to 16% for the dynamic R5 BM portfolios, all the way through to 4.31% for the P1 V1 V2 hybrid dynamic portfolio. Again, some good performance across the year, either in line with what you'd expect long term or outperforming a longer term trend. So nice to see that, that 2022 poor year is now behind us, and we're into a different environment really. We're looking at the top and bottom performers. We saw that Japan has had a fantastic opening start to the year, continuing what was happening in 2023. What's been going on there is there's a series of corporate governance reforms, which I won't drill down into the nitty gritty, but basically they should certainly be returning better returns for shareholders. That returning 12.25% over the quarter. And then we see the JPM US Research Enhanced Equity Funds, which I'll go talking about a bit more in a minute, but the US as well being a good performer over the quarter. When looking down at the worst performing funds, we see Hypnosis and Fidelity China, which is slightly surprising actually now talking about that nearly 3 weeks later, as this narrative on this has changed quite a bit. Hypnosis has rallied a fair degree over the last few weeks, and we've actually been reducing our position. Last week we've halved that position. We finished that on Friday, which was useful. We realized being above year to date, so the total return has increased more than 4% from that figure there. Fidelity China is behind the HSBC MSCI China passive ETF by quite a bit so far today. I've scheduled a call with the fund manager to find out why that is. It's, I would say, within the R portfolios is the one fund that I'm not particularly happy with how it's performing. So definitely going into research on why that is and whether we might be going through a change of the China position in R. But there's still China on the MSCI HSBC passive ETF on P is now up year to date. So that's positive there. And as mentioned, US government bonds pulling back, and actually would have pulled back a bit further since this was constructed. But that's actually fed into a bit of an opportunity that we have actioned today that I'll talk about a little bit more in a second. Oh, slightly outside, I should say Q1 2024, apologies. So looking across, trades out very much influenced Q1. You can see that going back in December, did a big change of selling of US government debts, putting that initially into money markets, and then also deploying that into sterling investment grade, which has been entirely the right move to do. As said, a second ago, US government debt has been selling off somewhat since the new year, and the replacement into the investment grade bonds fund in sterling has performed very well, which I'll explain a little bit more the advantages of that fund in a second. Then as we go through February, we see that we rotated a bit into the JPM US Rehash Index Fund, moving out from Fidelity passive equivalent. So I will actually, just because if I keep on referencing it, I'll just skip straight to that slide now, in fact. So that is, so the reason why we don't typically go active US funds over passives is it's quite a tricky environment. The US is the most analyst covered equity market in the world. And as a result, that means that by and large, what information there is to know is kind of shared and known quite easily by an awful lot of people. So it means that trying to find a share that perhaps you know something that other people don't know is quite tricky. So we tend to avoid active within the US for that reason. However, with this fund, there's a very clear process, which is JP Morgan have obviously their own bank of analysts, and they have had for the last 30 years a shadow portfolio run internally, which is they've used as a measure of how good their analysts have been. And what they do off the back of this is that they keep all of their weightings on a sector level. So, for example, industrials or banks, etc. They keep those weightings within the wider S&P the same. What they do is they just slightly change around, plus or minus 1%, the percentage weightings, of individual companies. So it means that you're not deviating massively from the benchmark. But what you then end up doing is you keep the general sector risks similar, so you're not deviating from that standpoint, but you're looking for the individual companies within those sectors that can outperform slightly. And there's a really long track record of this, which I will show in a second, but importantly as well, from an active fund standpoint, it's quite cost effective. It's 0.25% AMC, which is actually cheaper than in some areas a passive equivalent. So it's well priced. As I said, it's got a good track record. And since we have entered into this, so that's the one I'm after, we can see that it's outperformed the Fidelity passive equivalent by around about 0.9%, which doesn't sound enormous. But the key thing with that is that this fund very much delivers that little bit quarter after quarter and just keeps on ticking it up. If you go back to 2019, you can see what that little bit every single quarter adds up to. It's around about 10% over and above the passive equivalent. So as I said, it's not deviating massively. It's not hugely sexy. It's not trying to do, anything amazing. It's just trying to just add those little bits of quarter. And as you can see here, compared to, so that down the bottom, C is the sector kind of average for the Investment Association North America Fund universe. And so you can see it's outperformed that since 2019 by around about 20%, nice and consistently, just a little bit every time. And yeah, since we entered into it, as I mentioned, it's not huge, but an extra 0.1%. And it's just those little bits that just keep on adding up. And then we went to a similar position, which I didn't do a set of slides on just because it's a similar process. Very beginning of this month, we went into the T. Rowe Price equivalent. Here's the on the 2nd of April. Across the quarter, that's meant that it was actually quite quiet compared to what 2023 was like for trades. Only transacted 12 trades on the quarter. But we were well positioned leading into that, as mentioned, those trades that we did at the beginning of December. So there was just a little bit of looking around for new funds, not massively playing around with actual weightings of sectors. But as you can see there, quarter two, we've already done 10 trades. So this quarter's already looking quite a bit more active. The other fund that we added at the beginning of January, which I mentioned, was this sterling investment grade corporate fund, the Man GLG, which, if I can just get my drawer, this here. with quite a significant weight, particularly down in lower portfolios. We haven't gone all in on sterling investment grade as an active, just because of on the lower down portfolios. Sterling investment grade is actually the largest percentage holding, so we don't want to take such a huge active risk. So this is blended in with the passive equivalent, which is now the Fidelity sterling investment grade fund. But what this has is just finding the correct slide, as I was mentioning. So the UK market post Brexit is becoming far less covered than analysts. So this is the opposite of what I was saying in the US. So there's becoming more and more companies that there's less information known about. What that has meant is that if there are companies that are willing to go through and look at these, if there are analyst companies that are willing to go through and look at these smaller companies, there's potential of an advantage there just because of not everyone's looking at them. And the fund manager for this is really, really clear process in how he goes about this. And he has a really long track record and really positive track record. Before he moved to Man GLG, around about a year ago, he was at Schroders, where he did an earlier variation of this process, which worked. It's a development of this. And quite importantly, actually, because this is a smaller fund, it allows nimbleness. And what I mean by that is that if you have a fund which is literally billions in size, you cannot get rid of a position all in one go just because you're trying to put too much on there at any one time. So because this is smaller, it allows the fund manager to move in and out of positions a lot better. And also, because it's smaller, it makes it more interesting in order to go after these smaller issuances of investment grade debt. Since we have entered that, we can see that this is just since 15th of January through to yesterday's date. We can see there that it has outperformed the passive equivalents by over 4.5%, which is, it's fantastic over one quarter. It's actually been delivering that pretty much really well over the last year. And as you can see there, over the quarter, outperforming its peer group average by around about 4%, which means that, an extra alpha on average in the portfolios of around about 0.25%. So all of these bits are just adding up. And unfortunately, I didn't have time to include in my deck, but I've got it just inside of me here. Just similarly, the other active positions, the Allianz Continental European, outperforming again its peer group average and the passive equivalent by around about 1.5%. Our high yield debt active position similarly outperforming by at least 1%. Odd one out on the actives. Don't want to make out that literally everything's gone right on these funds over the quarter. Has been actually our active Japan position. Had a call with the team a couple of weeks ago, and that's due to its higher concentration than the mid-cap space rather than the large Mitsubishis or etc. that kind of space. However, there's definitely looking at this expectation that will close over the next few months. So I'm happy with that active fund position. But we share on Japanese equity, we go 50-50 between passive and active. Mark, did you just quickly want to go back over, just because obviously they got launched this year, just a little bit on P&R?
Yeah, sure. No, we had lots of good discussions with clients during the quarter. Actually, that was one thing I sort of should have said at the start of the presentation. So yeah, if anyone does want to reach out directly after, they've been good engaging conversations. Look, some people have stuck as they are, some people have split, some people have moved. So as we said, we've really just set them up to be two similar methodologies, but with just key differences between the two. So yeah, for those, again, just to recap, the P portfolios are the merging of our old V1 and V2 portfolios. We had set those up as different portfolios more for operational reasons than strategy reasons back at the outset in 2019. And yeah, obviously end of last year, just felt it was the right time to merge those together, and the P portfolio continues with exactly the same strategy that V1 and V2 portfolio had. We then, at the same time, certainly took feedback both from advisors and clients around, was there anything different to the DFM that we'd been running for sort of 4+ years? Was there anything different that we could put out there? We flirted with things like this in the past with composite indexes and green focused ranges of funds and stuff, but I think the message back was, well, what if I don't want to hold an ETF, or what if I that is perhaps too risky for me. It's kind of that trade-off between having the DFM with us having the decision making, but whilst at the same time having an interest in wanting to understand holding. So yeah, the R was really a sort of a result of that. So the R is a version of the P portfolios, and yeah, it just has a much tighter range to benchmark. So Sam can only go 2% above or beneath exactly the same benchmark, and we took the decision not to hold investment trusts and ETFs in that portfolio, and it runs with a passive focus. So Sam sort of spoken about the US American fund there in quite a bit of detail. So that would be an example where the whole portfolio has a focus on instruments like that, and yeah, we priced that one at 20 basis points, with the P portfolio at 35 basis points. So still hopefully very competitive in the wider world of fund charges and stuff. But yeah, that's the key differences between the two. The R range is also very versatile on some of the more tricky products like trusts and onshore bonds, offshore bonds. So all the money that we as advisors put into those products would only use the R portfolio now. So it's allowed a bit of a normalization of that as well. And yeah, just gives advisors and clients two similar but slightly different strategies for different times in their client history.
Cheers, Mark. Yeah, so one thing I would say is obviously you'll have each, because they are run differently, you have 1 month P outperform R, next one R outperform P. But we think, as was demonstrating just there, our active funds where we see value in them would over the long term produce a positive outperformance over R. So long may that continue. So yeah, as I looked a minute ago at what I was looking at 3 months ago, what could be the factors looking into Q1. When I was producing this a couple of days ago for looking forward for the next 3 months, not an awful lot of change. In actual fact, things kind of switched positions compared to 3 months ago. So first point is for inflation. So UK CPI figures came out today, a slight overreading over what was expected, but the general trend is positive. And not just that, I haven't run the numbers since this morning, but previously, if you annualized out the last 9 months of month-on-month readings of UK inflation, core UK inflation, you came out at 1.8% on average over the last 9 months. So, we're certainly heading down to an environment where on the Bank of England, probably in the not too distant future, will be actively considering a drop in the base rate. Conversely, when you look at the States, the month-on-month inflation figures haven't really changed since last July. In fact, possibly even longer than that. So although the US was the first kind of like major Western economy, where inflation did drop quite quickly, the problem is it's stalled for the last near year at about 3.7%. So we've gone from a position where everyone was thinking the Fed, there was one point actually coming straight to this year where it was expected that the Fed might cut rates 5 times this year. It's currently priced at around about 2. I wouldn't be surprised if it's not at all this year. If it would be, I think it would probably be 1 time. So treasuries are possibly still a little bit expensive, but they're starting to get back into their more, okay, this is more realistic region. Whereas, however, with gilts, I think there's an opportunity there for some capital gains over the next 9 months. So, as a matter of fact, did trade this morning, allocated some of the cash realized from hypnosis sales in 2 gilts based on that point. As mentioned very briefly, China is still a fantastic play from a value standpoint. Was having quite a conversation on LinkedIn. I don't post on LinkedIn awfully often, but talking about the longer term valuation ratios for China relative to India. India's had, did have quite a good rally, which we would be exposed to within the passive emerging markets fund. But it's now starting to look a little bit pricey. And certainly when you take the next 10 years of earnings relative to China, China's looking fairly good. Obviously, China, the one thing that will hold it back for some time will be geopolitical tension. But from a pure business and financial standpoint, China is still quite a good earnings area to be looking at. Looking at the Purchasing Manager Index data, so what we're seeing is that UK and Europe are now starting to pick up again. Europe's actually, for 2023, was actually quite disappointing. Even Europe's now starting to move back above the neutral level, start to move back to positive territory. So active European holding, which mentioned earlier, I expect to continue outperforming for the year, which would be fantastic. And then also the UK, because the indicators are looking a bit more positive, we might be looking a little bit more at increasing UK mid cap or possibly even a minor position into UK small cap, just off the back of this. And Q2 earnings season has really started off. It's a bit of a mixed bag in the States. I think we might be moving towards the time when the US has had its big rally for the year. So it'd be interesting to see how that develops relative to other geographies. Be something to keep an eye on, certainly for the next couple of weeks. Might be a little bit of a derating in our position in the US, moving elsewhere. But I think as a starting point where we're positioned, it is decent. It would hold through even if we weren't to do enter two portfolios. But I think we can improve upon it further and help push our returns higher still, which is obviously the aim. Just looking at just the meetings for this month, sorry, I should read April. You see there have been a very busy last week and this week. Just came straight off of a roundtable meeting a second ago to come straight into this, as well as also before that talking about Chinese macro and policy with Fidelity, and then some more webinars, etc. this afternoon. So certainly a very busy week, but feeding into lots of ideas for the portfolios. Just looking here at our current portfolio positioning versus internal benchmarks. Sorry, unfortunately, this is so much information. It's hard to make this clear on one sheet. This is, as I mentioned, slightly out of date because we've been doing some trades. So see here the money market, which you could use as proxy for cash. Also, saying that we're very overweight, been deploying that this morning. That cash existed as a result of the hypnosis sale, but it's also helped protect us from the downward market movements over the last week. So that's helping give us some extra alpha in the portfolios. Gilts already are slightly positive, but we can see further value in that. So moving that a little bit more positive again, particularly in index linked, showing that there's some value there. And then, yeah, as saying previously, Japanese equities on the higher up portfolios still being around about 1% over benchmark, and that's helping deliver some extra performance as well. So Yeah,
Just to confirm, Sam, is that as of now or as at the end of the quarter?
So this was as of yesterday, prior to the trades going through this morning.
Sure.
So that is end of my slide deck. I tried to make my slides more concise this time around. Sometimes I try to cut too much on there and leave this time free for questions and answers. Definitely more than welcome from anyone, internal or external, to throw questions on here. Certainly look forward to answering them.
Thanks, guys. We actually don't have any questions come through at the moment from anyone, so I'll leave it for a couple of moments. But I will just use this moment just to say, again, we're going to be putting a survey up. So anyone who's got 30 seconds of time to leave the feedback, again, will be appreciated. And if there's anything that you do want clarifying or you think of later on, then obviously please reach out. I'm sure Sam and Mark would be more than happy to answer any questions that you might think of. And keep an eye out, because you will receive a copy of the recording and presentation as well later on today. Those of you who have attended, or even anyone who's signed up or might not be able to stay for the full presentation. So keep an eye out for that today. Looks like we have got someone typing something out, so just wait for that to come through.
Yeah, I just had something that sort of maybe come up in more client meetings, is sort of, again, just sort of trying to establish targets, which obviously, our targets are derived off what we want to be hitting over a sort of 5-year period. But I think, one thing that is certainly pleasing is that, looking at 2023's returns, which we obviously presented 3 months ago, just getting the portfolios back to that sort of 5 to 9%, range. We'd probably like a little bit of a wider range in a totally perfect world. But, as Sam sort of, put on the slides at the start, again, having banked that return last year, the R portfolio already being up to sort of 7% up, but again, doing as it should. And it'd be lovely to continue that trend quarter on quarter, year on year. And I think so much has happened in the world. I did a much longer analysis of a client's portfolio the other week. It's lovely to sort of have had client relationships sort of spanning 10 years now, and sort of reporting back. So but it just sort of showed again, 2018, 19.9% pullback in the S&P 500 didn't get marked as a bear market. But I think having sort of had that 2018, 2020, 2022 events to sort of come out of that, I really feel it's those sort of 3 cycles that have set the path forward for hopefully a bit more of a normal 5 to 10 year period. Not saying things can't happen, missiles flying and things over the weekend put Sam in a hot sweat, messaging me very early Sunday morning. But yeah, I think going back to what my original point was, the target returns of that sort of 5% for the low portfolio up to sort of the 9 to 10 average for the portfolio 5 is sort of where we feel there's a bit more of a path to head back to now. And the other question.
So yeah, we do
I'll
have
let
a
Sam
question.
answer that one, because I know he's given me an opinion on that recently. So.
Yeah, cheers, Neil. Yeah, this is something that I've been looking at quite a bit. So I think short and medium being 3 years term India is expensive. I will ping to the advisors and they'll forward to you after this. I'll show you a chart of so something called the CAPE model. So the CAPE model is it's how expensive is a company compared to its future 10 years earnings. And when you look at that model, India, people are saying about how expensive the United States is at the moment, that market. and it certainly has started to get quite a bit expensive again. India is far more expensive than the US at the moment. I just think whether or not it performs well over the next 10 years, I think there's better opportunities in the short to medium term. One thing I would say is that economy growing doesn't necessarily mean improved performance in companies. I think a very good example of this is Vietnam. So Vietnam obviously as an economy is doing great. Got a few foreign exchange issues at the moment, but by and large, it's doing really, really well. The companies, though, themselves are not necessarily performing great. So the two things don't necessarily go hand in hand. However, yeah, as you mentioned, Modi's reforms are the right direction, but they need some way to go. And not just that, the hype is quite priced in. In 2023, it had such a rally that it became a bit too much for us to consider going back into. We looked at it, but to be looking at it now is just certainly too expensive compared to other markets. I'll have a look at it, but and certainly will throw out the graph I was referring to, Neil, because it's an interesting conversation.
Lovely. Okay. No other questions at the moment. So I'm going to put the survey up. Otherwise, thank you very much, guys, for your time. It's a great presentation. I'll leave this up for the next kind of 10 minutes or so. So please feel free to take your time and leave the feedback as and when you'd like. Otherwise, we'll see you next time.
Thank you all.
Thanks, guys.